Hello everybody! Why did I buy AIMS APAC REIT at 1.29 in September? So the last video that I made talked about my purchase. So I'll put the link over here and you can go check it out if you want. But basically some viewers were asking for my rationale for buying the REIT and some more details. So let's talk about it. So this is the my order at 129 in 26 September. The timing wasn't that great though, because after that the share price fell to 124, 125. So, but too bad I'm not a very good timer. But if you look at the charts for the past 5 years, so this was what I was looking at in August and September, because I was thinking that the markets will be volatile, and I wanted to buy some stuff that I always wanted, and this was what I discovered. So this is the Bollinger Bands. I can see that you can divide this REIT into three halves, right? Three periods: pre-COVID, COVID, and post-COVID. And let's just ignore the COVID period, right, where everything just went berserk. And you can see the volatility really blew out, right? The Bollinger Bands really expanded in volatility. So pre-COVID, actually this guy was really well behaved, right? You can see it stayed within the Bollinger Bands consistently, centering around the moving averages, and it hardly ever breaks out, right? You hit the upper half and you go back, and you hit the lower half and you bounce back in. So it's a bit of a mean reversion kind of a REIT in the past, centering around the NAV, I think. So post-COVID, actually you can see the pattern diverge a bit. Post-COVID immediately, you can see that there's been quite a big uptrend, right? Trading above the MAs all the time and hitting the upper halves of the Bollinger Bands quite consistently. I think a big reason for this was the anticipation of the inclusion of the REIT into the index, and therefore there was probably some front running, right, to pre-run the funds that would buy up the REIT upon inclusion. You can see it hit a pit of 1.6, right, post inclusion in September, and since then share price has been falling back. You can see the volatility has come off, and share price trending downwards. But again, it's reverting to what it was, centering around the MA, right? And if you look at the candlesticks and draw the trend lines connecting the highs and the lows, you can see that the pattern is quite clear as well, right? Lower highs, but the bottoms have been quite interesting though. Quite strong support at the 133, 132 area. So looking at the Bollinger Bands and the candlesticks and the trend lines, my thought was that I'll put a buy at 132, and then for my first order, and if it gets filled then and it falls, then I'll look at the trading pattern post the fill and decide when to fire another bullet if there is one. So my intention was to put a bid at 132, but I was too busy, and then next thing I know, when I look at the screens after I came back, it was trading at 129. So therefore I just went in and bought it at 129. But you can see that the candlestick pattern is actually quite bearish. The three red man is back, and this is always a very strong pattern in technical analysis, candlesticks wise. But my suspicion is that this is actually the funds they have bought in over here, right? You can see the volume is quite decently high as well. Not that high. I mean, like if you compare it over here, the buy volume over here, the volume over here is a lot higher than the stuff over here, right? I think funds that were buying over here eventually kind of sold over here upon the capital outflow and perhaps a redemption. I don't know, but I was quite happy to buy over here though. So fundamental wise, let's look at the how this REIT performs against the wall of worries. So I introduced this concept in a video previously. I'll put the link over here. We'll talk about the Ascenders REIT. So these are probably the main worries that the market has currently. So Russia, Ukraine, and the effect on Europe, China COVID, recession and the consumption slowdown, inflation and utility hikes, rate hikes, of course, which dominate the discussion nowadays, and also the cap rate window, which I think is narrowing. So let's get how this REIT performs against each of these factors. Actually, to be honest with you, I think of all the worries we have over here, I think the discussion that dominates right now is rate hikes. But my main concern is actually Russia, Ukraine, and the effect, especially on Europe. I cannot rule out the chances of a nuclear involvement of Russia, and also the gas supply and energy crisis in Europe, fragmentation fears of the peripherals, and so on and so forth. So my fear is actually not on rate hikes. My main fear is on this thing actually. So my preference is to avoid anything to do with Europe, especially Eastern Europe. So that's my main worry. The rest of the stuff actually not that worrying for me actually. I think the recession fears are quite real though, because I think we are clearly going to a recession, if especially if the Fed does not pivot. So let's look at how this REIT performs against the factors. So first of all, the Russia, Ukraine, and the effect on Europe, right? This guy doesn't have any European exposure, just Singapore and Australia. So that is the first and most important thing. It's gone. It doesn't have any China geographical presence as well. So two factors gone, and it's very important, right? Because I really don't want anything to do with Europe. At the right yield, I'll be happy to take a bite of European exposure. But at current levels, I don't think anything with European exposure is attractive enough to me. So let's look at the second factor, which is recession and consumption slowdown. I don't think it's a big problem because let's say you have a recession and so on and so forth. 40% of the leases expires in 2028 and beyond, right? So if you look at if you include the 26 and above, actually 50% of the stuff are still long leases, right? So you have some near-term expiries over here. But if you look at the lease rental reversions for this stuff, it's 10%, right? So well, if you have a recession looming, I doubt the tenants would be renewing their leases at 10% rental reversions, right? So while the consequences of a recession is unknown, I think the presence of the 50% of the leases beyond 2026 is a big mitigating factor. So these two factors are also gone. For inflation and utilities, I don't think anybody can escape from rising electricity and gas prices. But one good thing is that if you look at the rental reversions, fourth quarter up 6%, first quarter 23 up 4%. So well, they're still able to reversion rate was 15% and 10%, right? This is the percentage of the renewals. So a decent portion of the leases are renewing at a higher rate for both quarters. So while if you have rising utilities, hopefully you can pass on some of this stuff through service charges. But another mitigating factor is for rising rentals, right? So if your expenses go up, but your revenues go up as well, then while your bottom line is still quite secure, right? So that's the mitigating factor. For rate hikes, I think this guy is really well covered, man. If you look at the balance sheet, in 2023, nothing is expiring. If you look at 24, only 31 million, right? So like really, really low. So if you look at these two stuff add together, just 4%, right? Only 4% of the debt will expire in the next 2 years, 23 and 24. Of course, there are some expiring over here, like 12% or something. But even look at the debt for the next 4 years, right? 2023, 24, 25, 26. It's like less than 15%, right? What, 11, 12, 13% only. Of course, if the Fed hikes forever, then this guy will ultimately get into trouble with refi. Well, it's not getting into trouble. You will have to refi eventually at the higher cost. But everybody will suffer the same thing as well, right? So of all the REITs, I think this is probably the least conservative of the most conservative balance sheet. At least one of the most conservative balance sheet. Very low debt maturing in the next 3-4 years. So I think it's quite well shielded from the rate rises. And if you look at the interest rate management, 88% of the debt is fixed, so very little float, right? So a rising rate now will hit a very little floating debt profile, and very little is expiring either. So I think interest rate management is really good. For FX, there's natural hedges as well. A bit of unhedged in 32%. But then it's just Australian dollar, right? So it's down like 5% or so. But well, nothing much, nothing too crazy, right? Compared to Europe and the sterling, the yen, and stuff. So Singapore and Australia, right? Well, I think the last thing is the most is something all investors should be quite concerned about, which is the cap rate window, right? Given rising interest rates, rising so therefore rising interest rate costs, falling share prices, therefore rising equity costs. and the reluctance of asset prices to correct significantly, I think we have to watch out for any dilutive acquisitions, right? So there's some rumors about the acquisition in this Macquarie Park place. So this is one thing that we have to look out for. If the manager decides to buy this stuff, would they be able to fund this stuff in a creative manner? But I think this is something that applies to all REITs. So in this environment, any dilutive acquisitions will be taken very negatively. But I guess one good thing is that for if you look at across the all asset classes, industrial properties still have a decent cap rate, right? Compared to retail, especially in Singapore, and commercial like offices, so on and so forth. So I guess that's one mitigating factor. But one factor that we should all look out for. But if you look at the performance of the manager so far, it's been quite decent, right? Look at the NAV has been improving. And this stuff over here is a result of AIs and stuff, right? Especially the revaluation of the assets in Australia, where the demand for logistics, properties, industrial properties has been pretty strong due to rise of e-commerce and stuff like that. And look at the DPUs. So they mentioned 0.5 over here, right? First quarter 23 was 2.28. Then last quarter was 236, then 235 and 2.5. And based on the trailing 12 months and divide the share price, you get the 6.9%. But that was the share price back then, right? Of my purchase price of 1.29, you're talking about 7.5% dividend yield, right? Trading below book and stuff. And so this is the reason why I bought AIMS APAC at 1.29 versus an NAV of 1.4. So that's it for this video.